Credit is important. Credit is important. Credit is important. Credit is important. Hey guys, it's your girl Soul from Tay and Soul, the Winfreys, period. I'm doing this video solo because I have a lot more passion about it than Tay does. And that's cool, that's gravy. It's just no point of him standing here looking like, right, yeah, what she said, because that's all that will be happening there. But in case you did not notice, this video is about credit. It's about what a credit score is, what components make up a credit, as well as what are the ranges for a credit score, so that you can be informed and ready to go whenever you need your credit to be a reflection of you. So let's go ahead and dive straight into it. And before I get started, don't forget to like, subscribe, and share. Comment any questions you have, any additional input you want to provide. And also, full disclosure that I am not a financial advisor. The information I'm sharing with you today does not guarantee any type of results. You should seek your own financial outlet, your own financial advisor. Do not rely on strictly what I am saying on this video. And with all that being said, let's get straight into it. Credit is your word. So, in the eyes of banks and lenders, your credit is a reflection of your ability to, for one, be consistent, to live within your means, to be patient, and to hold up your end of an agreement, and also access to funds in case life happens. Because as we know, life happens a lot. So first, let's start off with what are the possibilities when it comes to credits and credit scores. So first, let me preface that with saying that there are two different types of credit scores. There's a FICO score and a Vantage score. They're honestly really similar as far as what you need to do to get a great score in both, and how they are graded is pretty similar as well. So the main components I'm talking about are definitely for your actual FICO score. But again, if you follow these steps, you'll also have a really great Vantage score as well. The first thing that you need to know is that your credit score can range between a 300 and an 850. If your score is at least 580, that means that your score is going to be pretty fair. In order for you to be considered good credit, you need to have at least a 670 credit score. And in order to make it to the next tier of great credit, 740, and then exceptional would be an 800 or above. Anything below a 580 would be considered bad credit. And that's just the black and white about it. There's no gray area with that piece of it. So, I also want to talk about what it is that banks and lenders are actually looking at and looking for when they pull your credit and when they are requesting information about your credit. So, this is also listed in order of importance. So, what has a higher weight on your credit score, and what most credit bureaus, banks, and lenders are actually considering to be the most important piece. One is payment history. So, any late payments that you have are going to negatively impact your score. There's no ifs, ands, or buts about that. Not every single last thing reports back as a late payment, but I can tell you things such as like a mortgage, things such as student loans, medical bills, any actual loans you have out, anything like that that's going to will report back as a late payment if you don't make your payments on time. Another thing that they look at is the amount of money that you owe. So this is not just for one credit card. This is not just for one bank. This is not just for one loan, any of that. This is a collective group of how much money you owe. There's actually something called a debt to available funds ratio, and that is literally just what it says. It's the ratio or the fraction or however you want to look at it of how much money you owe compared to how much money you have access to in the forms of credit. That part is very important. Um, I've heard people say, "Well, have all this money in my checking account or in my savings account, so my credit has to be really good," and that's just not the case. They're looking for um, your available funds and credit because anything can happen to where your actual cash is gone. That's the whole reason why credit is used because you're not wanting to use up all of your cash or you don't have the cash yet to use it all up. So they look at your debt as far as how much you actually owe compared to your available funds. So when it comes to using credit in terms of credit cards, let me tell you what the actual percentages are. So, in order for you to have the best scores regarding your credit usage, you want to keep your credit utilization between 1% and 29%. If you hear anybody else say this, if you research it, you'll see it says anything under 30%, don't even focus on the 30, 29 is the number you're looking for. The reason why I start at 1% and not 0% is because banks and lenders want to see that you are able to manage credit. What they don't want is to see you go and buy something worth $20, whatever the amount is, and then you pay all $20 off. That means that you have the cash, and that doesn't tell them that you're good at managing credit and making payments consistently over a course of time. So 1 to 29% is where you want to be. For best results, 1 to 9% is definitely the golden rule. 1 to 9%. Keep it under 10% utilization, but do not drop it down to 0. The next factor that they look at is the age of your oldest account. So how long have you had your oldest credit card, or how long is the loan that you have open? How long have you had that account open? So student loans are typically the longest that most adults will have, unless they ask for a line of credit or ask for a credit card as soon as they became an adult. Or they can go to school and just, there's so many options, but it's literally the amount of time that you've had your oldest line of credit. In order to have the best results, you need 9 years. And there's no way around that except time. So that one requires a lot of patience to even get to that milestone. The next piece that banks and lenders check into is your mix of revolving and installment loans. Let me break that down for you. So let's start with revolving. A revolving loan is simply put a credit card. It's something that you can purchase and you don't have to have the previous thing paid off in order to get to it. It's not a set amount that you have to pay each month or anything like that. That kind of helps them understand if you're living above your means or not based on how you are spending and paying for your credit card. So they want to see how many revolving accounts you have open. So how many credit cards you have. And then you have installment loans, which are like mortgages, car notes, things like that, where you pay a set amount to pay something back each month for a certain period of time. So a mix of those are what they're looking for to see if you are living above your means or not. If you have a 2 car notes, a home mortgage, and then you also have 3 different credit cards that you've been utilizing, and it's going to make it look like you're kind of living above your means there. And one of the other things that banks and lenders look into is your credit inquiries. Credit inquiries are literally if you are doing anything that's going to hit your credit. So the good thing about this is that credit inquiries fall off after 2 years. However, you gotta wait 2 years for them to fall off. So 2 years is kind of a long time, but it's not the worst given that your credit history is typically going 7 years back for things that are considered relevant. But Yeah, they also check your new accounts too. So aside from your credit inquiries, which one of those actually resulted in a new account being opened? So if you shop for a car and every time you go to a different dealership or you try a different bank, they're gonna check your credit to see where you're at. And um, yeah. Lastly, on here, I wanted to tell you guys a little bit about um, some of the things. I want to tell you guys a little bit about some of the things that will still negatively impact your credit. Um, Bankruptcies. Bankruptcies are when you file for bankruptcy, you're filing for a fresh start because you don't have the funds to live the life that you either don't have the funds or don't want to deal with the funds that you need to put you back at a zero um, for debt. So that is okay, and there is no shame on anyone actually getting a bankruptcy. However, look from it as if you were the lender, right? And someone who just had a bankruptcy is coming to you and saying, "Hey, I really need to borrow this money. Can I do that?" Think about your friends and family when they ask to borrow money. Now, think about if they just told somebody, like, "I can't afford you to pay you back. I'm sorry, but you're just gonna have to chuck it up as a loss, and I'm never gonna owe you this money." Would you lend that person money? No. You want to take a little bit more time to see if they've actually had changed behavior before they just give you money or before you just lend out money to your friend or family. And that's the same way banks and lenders feel about when you first have a bankruptcy. Foreclosures are the same exact way. Foreclosures only come from home ownership. So if you own a home and you ended up saying, "Hey, I can't afford to pay this," you're just gonna have to foreclose on a house, whatever case may be. It kind of goes hand in hand with the same way they look at bankruptcies. Evictions, hey, same thing. You didn't pay them their money. And then wage garnishments, you lost in court and you ain't pay them their money. Now they're forced to take legal actions to where someone's automatically taking it out of your account. So, all in all, credit lasts a total of 7 years. And if you think about it, if you want to keep thinking about it, your cells regenerate every 7 years. So you're a new person every 7 years. And I guess that's how credit bureaus look at it as well. Um, but yeah, that's it. That's kind of everything that goes into making up a credit score. Um, I do want to show you guys this as well. So, a lot of people actually think that the majority of Americans are at this fair or not good credit at all. And that's actually not the case. The majority of Americans are actually here between 740 and 799 credit score. Um, the second highest is actually in the good category, and then exceptional, and then fair and below. So I wanted to say that to let you know that it is possible for you to do. Please just let me know what you think. Like, subscribe, and share, and comment your thoughts. Any additional information you have to share with the people. And have a really great day.